Ever wonder about, you know, those invisible forces,
Hmm.
the ones that make markets jump up or suddenly crash down, or maybe how we keep all our digital stuff safe?
Yeah, it's pretty critical stuff.
Well, today, we're going to try and pull back the curtain on some uh, surprisingly powerful ideas behind all that. We'll be looking at something called derivatives in finance,
Mm-hmm.
and also some really cutting-edge thinking around advanced data protection. It might sound, well,
Might
complicated,
have seemed that way, for sure.
but trust me, there are some really fascinating insights hiding just beneath the surface.
That's right. And you shared some really interesting sources with us on both finance and data security.
Hmm?
So we're excited to really get into it, take this deep dive.
Yeah, what's our mission here?
Well, I think the aim is to kind of get past the jargon, right? And
Cool.
pull out the core ideas, maybe find some unexpected connections, things that really shine a light on how these critical areas actually work.
Exactly, because whether you're, trying to get up to speed for work, or maybe you're just curious about a new field, or even if you just want to be more informed, understanding this stuff can give you a real edge, I think. We're looking for those aha moments
Yes.
and hopefully deliver them in a way that's, clear, makes sense, and doesn't waste your time. Ready to jump in?
Let's do it.
Okay, so let's unpack this first source. It talks about something called the trillion-dollar equation.
Sounds pretty dramatic.
It does, right. But honestly, it's not really an exaggeration. We're talking about a single piece of math that's had this just massive impact on global finance,
Yeah.
especially in the world of derivatives.
Mm-hmm. Trillions and trillions of dollars.
Exactly. Trillions changing hands in these markets. And this equation, it fundamentally changed how people think about and manage financial risk. It's almost mind-boggling when you really stop and think about the scale.
It truly is, and there's often this huge gap, isn't there, between the sheer size and influence of these financial tools
Yeah.
and what, the average person actually understands about them.
That is so true. I mean, the numbers alone are just impossible to really picture. But the basic ideas, they don't have to be completely shrouded in mystery.
Right.
Think of a derivative, basically, as a contract, right?
Hmm.
Its value derives from something else,
An underlying asset, yeah.
like a stock or a currency, maybe even oil or wheat. It's like making a bet on where something will be in the future, but without actually owning that thing right now.
That's a good way to put it. And it highlights that these tools, okay, they're complex in how they're used,
Sure.
but fundamentally, they're about managing future possibilities, future risks.
Exactly. So we're going to take a bit of a journey into the heart of these derivatives. And what's really fascinating, I think, is how much of the truly groundbreaking thinking in finance actually came from people with backgrounds in fields that seem totally unrelated.
Like physics.
Like the really rigorous quantitative world of physics, yeah.
That's such a key point. It really challenges that old idea that, understanding finance is only for people with traditional Wall Street backgrounds. Applying that scientific rigor, that data-driven mindset, it's been incredibly powerful.
Absolutely. Because when you start looking at markets through that lens, through data and statistics, you can start to spot patterns, insights that maybe the more traditional sort of gut-feeling approaches might just miss entirely.
You've got a different toolkit.
Exactly. A completely different set of tools.
Precisely. And it lets you do analysis that can uncover these really subtle signals hidden in all the market noise. And speaking of blending, hardcore math with financial insight, we absolutely have to talk about this remarkable story. A mathematics professor who became a, legendary hedge fund manager.
Oh, I think I know who you're talking about. Not your typical pinstripe suit guy, right?
Not at all. Straight out of academia, built a financial powerhouse back in, 1988. He launched the Medallion Investment Fund.
Right, Medallion. And the returns were just unreal.
Yeah. Absolutely extraordinary. For 3 decades, it wasn't just good performance. It was like on another planet compared to everyone else.
We're talking an average annual return of 66%. 66%.
Just let that sink in.
Year after year. If you'd put, say, $100 in back in '88,
Yeah.
it would have grown to something like $8.4 billion today. It's just, it really makes him arguably the ultimate mathematician turned financial wizard.
No question.
What do you think is the most, significant thing about that kind of consistent outperformance?
Well, what's truly amazing is that it wasn't based on picking stocks the old-fashioned way or following market trends like everyone else.
Right.
Instead, it was about treating the market like this enormous data set, something to be just meticulously analyzed for statistical anomalies.
Like data mining.
Exactly. They were essentially mining the market,
Yeah.
looking for these tiny recurring patterns so subtle that most people, most traders, wouldn't even notice them. The key idea here is that market inefficiencies aren't always these big, obvious mistakes in pricing. Sometimes they're just these incredibly faint statistical signals.
That only sophisticated quantitative methods can actually pick up.
Precisely.
It's like they were speaking a completely different language than the rest of the market, finding order where everyone else just saw randomness.
Yeah.
But it also kind of reminds us, though, that even with the most brilliant math models, the market and, well, human beings can still throw a wrench in the works, right?
Absolutely. And for a really powerful, maybe humbling illustration of that, we just need to look at the story of Sir Isaac Newton.
Wait, the Isaac Newton? Gravity, calculus, all that.
The very same. But even he famously got caught up in the South Sea bubble back in 1720.
Oh, yeah, the bubble.
And let's just say it didn't end well for him financially.
Unfortunate is putting it mildly. He lost a huge amount of money, didn't he?
A fortune.
And that quote of his afterwards is just perfect. I can calculate the motions of the heavenly bodies, but not the madness of people.
It really puts the limits into perspective, doesn't it? Even for the most brilliant minds when it comes to markets.
Totally.
It perfectly highlights that crucial tension between the rational mathematical models we try to build and the often very irrational human element that drives so much market behavior. The psychology, the fear, the greed, the herd mentality.
All that messy human stuff.
Exactly. You can have the most elegant equation, but if you ignore the madness of people, you're missing a huge piece of the puzzle.
So going back to our mathematician hedge fund manager, were they just better at predicting that madness, or was something else going on with their consistent success?
Well, a huge part of their success, and this ties right back to our earlier point about insights coming from unexpected places, was built on the foundations laid by some real pioneers. People who dared to apply mathematics to the seemingly chaotic world of finance long before it was fashionable.
Okay.
And to really understand that, we need to rewind. Go back to the late 19th century and the work of a Frenchman named Louis Bachelier, born in 1870.
Bachelier. Okay. And his path wasn't exactly conventional either, was it?
Not at all. Lost his parents young, ended up running the family wine business for a bit.
Wow. Okay. Wine.
Then sold it all to go study physics in Paris.
From vineyards to theoretical physics. That's amazing.
Isn't it? And then, needing to earn a living while studying, he ended up working at the Paris Stock Exchange.
What a journey. What strikes you about that sequence?
Well, it's like he was uniquely positioned, right? He had the practical business sense from the wine trade, then the super rigorous analytical thinking from physics, and then firsthand exposure to the messy day-to-day reality of the market floor. It's often that kind of mixed background that sparks real innovation, connecting dots others don't see.
Makes sense.
And the Paris Bourse, the stock exchange back then, it was a lively place, almost frenetic.
I bet.
But within all that seeming chaos, Bachelier believed there were underlying patterns, mathematical patterns, and he got particularly interested in options trading.
Options. Okay, these can sound complicated, but the basic idea is actually super old, isn't it? Goes way back.
Oh, absolutely. You can trace it back to 600 BC. Thales of Miletus, the Greek philosopher.
Yeah.
He supposedly cornered the market on olive presses one year. He didn't buy the presses outright, but he paid a small fee to secure the right, but crucially, not the obligation.
Ah, that's the key part.
Exactly. The right, not the obligation, to rent those presses at a set price later on. He anticipated a big olive harvest, locked in his rental price, and made a killing when demand surged. He was essentially buying an option.
So even way back then, people were figuring out ways to handle future uncertainty. Fast forward to Bachelier's time, options were traded, but pricing them was more art than science.
Very much so, based on intuition, gut feel, guesswork. But Bachelier, with his physics training, he was convinced there had to be a more rigorous mathematical way to figure out a fair price.
And that's what he focused his PhD on.
That's exactly what he did. His doctoral thesis, submitted in 1900, was titled The Theory of Speculation.
Can you imagine proposing that back then? When math and finance were seen as totally separate worlds, his advisor was apparently pretty skeptical.
It was a radical idea, but it just shows how forward-thinking Bachelier was. He was way ahead of the curve in seeing how you could apply Serious mathematical analysis to market dynamics.
So he's trying to find order in this apparent chaos, trying to price options mathematically. Where did he even start? What was the first step?
Well, before you can price an option, you need a way to think about how the price of the underlying thing, say, a stock, actually behaves over time.
Right, you need a model for the stock price itself.
Exactly, that's the foundation. And this is where Bachelier had a really key insight. He realized that trying to predict every little up and down tick, influenced by news, rumors, everything, it was probably impossible.
Yeah, there's just too much random noise, right? Economic reports, global
Yeah.
events, just shifting investor moods.
Precisely. So Bachelier made a simplifying but powerful assumption. He basically said, at any given moment, the price of a stock is equally likely to go up as it is to go down.
Like a coin flip, 50-50.
Exactly. A 50-50 chance.
And from that simple idea, he developed the concept of the random walk.
The random walk, yeah. The idea that prices move unpredictably from one moment to the next, just sort of bouncing around randomly.
Okay. And if prices follow a random walk, what does that imply about trying to predict them?
Well, it strongly suggests that trying to predict future prices based only on looking at past prices is probably a waste of time.
Which sounds a lot like the efficient market hypothesis, right? A really central idea in finance today.
It leads directly there, yes. The basic idea of the EMH is that in an efficient market, all the information out there is already baked into the current price.
So you can't consistently beat the market just by trading on stuff everyone already knows.
Exactly. And Bachelor's random walk theory really supports that. If past prices don't predict future prices, then technical analysis, looking for patterns in charts, probably won't give you a reliable edge.
That aligns with the weak form of market efficiency, doesn't it?
Precisely. Economists talk about different levels. The weak form says you can't profit from past price data alone. Then there's the semi-strong form. All public information is already priced in. And the strong form even argues that private insider info won't consistently help. Bachelier's work really laid the groundwork for understanding those first two levels.
Okay, so we have this picture of a random walk. Prices bouncing around unpredictably. Sounds like total chaos. How did Bachelier manage to find any kind of order or predictability in that?
This is where a great visual analogy comes in handy, the Galton board, sometimes called the golden board. Imagine one of those upright boards with rows of pegs, like a vertical pinball machine without the flippers.
Okay, yeah, I can picture that.
Now you drop thousands of little balls or beads from the top center. As each ball falls, it hits the pegs and randomly bounces left or right. A 50-50 chance at each peg, right? Just like Bachelier's idea of stock price movements.
Right, you can't predict where any single ball will end up. Totally random path.
Exactly. But when you look at where all the dolls collect at the bottom, what shape do they form?
They form that bell curve shape, the normal distribution.
Precisely. Order emerges from the collective chaos. And that's exactly how Bachelier viewed stock prices. Each tiny random up or down tick is like a ball hitting a peg, unpredictable individually. But over time, the distribution of all the possible future prices forms that predictable bell curve.
Okay. Centered around the current price, but spreading out more the further into the future you look.
Exactly. The range of possibilities widens over time.
That's a fantastic visual. And didn't his work on this radiation of probabilities, as he called it, actually overlap with something discovered in physics decades earlier?
It did, remarkably. Back in 1822, Joseph Fourier developed the famous heat equation to describe how heat spreads or diffuses through a material over time.
Right.
Bachelier, working completely independently and focused on finance, essentially rediscovered the very same mathematical framework. He used it to describe how probabilities diffuse or spread out in financial markets.
Wow. That's an amazing example of convergent thinking, finding the same math in totally different contexts.
It really is, although, ironically, the physics community at the time didn't really pick up on Bachelier's work in finance. But that same mathematical understanding of random movement, the random walk, later became absolutely crucial in solving a major physics puzzle.
You mean Brownian motion?
Exactly. Back in 1827, the botanist Robert Brown saw tiny pollen grains jiggling about randomly under his microscope when suspended in water.
And nobody knew why for ages?
Right. It was a mystery for decades.
All right.
Then, in 1905, that miracle year for him, Albert Einstein published his explanation. He theorized that these visible particles were being constantly bombarded by tiny, invisible water molecules, causing them to jiggle randomly.
And his mathematical explanation for that, Jalen?
Relied fundamentally on the concept of the random walk. He showed that the statistical distribution of where a particle might end up after a certain time would follow that same bell curve pattern diffusion.
Okay, this is fascinating. Was Einstein aware of Bachelier's earlier work on the same mathematical principles?
Apparently not. It seems to be a case of completely independent discovery. Two brilliant minds, one in finance, one in physics, arriving at the same fundamental mathematical description for seemingly random processes.
It really underscores how universal these mathematical ideas are, doesn't it?
Absolutely. It shows these principles pop up everywhere, describing everything from heat flow to particle physics to, well, stock prices.
So by the time Batchley finished his PhD, he'd basically built this whole mathematical framework. He had the random walk model for stock prices, the probability distribution. How did he use that to actually price an option?
Well, now that he had a way to describe the probability of the stock price ending up at any given level in the future,
Uh-huh.
he could calculate the probability that the option would be profitable for the buyer, meaning the price ends up above the strike price for a call option or below for a put option.
Okay.
And conversely, the probability it would be profitable for the seller, he could then multiply the potential profit or loss in each scenario by its probability.
To get an expected return.
Exactly. An expected value or expected return. And his key insight was that the fair price for the option should be the price where the expected return is essentially the same for both the buyer and the seller.
Ah, so it's balanced. Neither side has an inherent advantage based on the probabilities.
An equilibrium price.
Precisely. A price based entirely on the mathematical expectation derived from the random walk model.
That's genuinely profound for the time. But, as you mentioned, the irony is, nobody really paid much attention back then.
Largely ignored, yeah. It's a classic case of being too far ahead of your time. The finance world wasn't really ready for that level of math, and the physics world didn't immediately grasp the connection or its importance. His work kind of faded into obscurity for decades.
But the seeds were planted. The revolution Bachelor started was maybe just brewing slowly.
Exactly. And a really key figure in carrying that torch forward decades later was another fascinating character, Ed Thorpe.
Ah, yes.
Yeah.
The guy who beat the casinos.
Yeah.
The physics PhD who figured out card counting and blackjack. That's the one. Back in the 1950s and 60s, he literally wrote the book on it, Beat the Dealer.
And after taking on Vegas, he turned his mathematical brain towards Wall Street.
He did. He launched a hedge fund, Princeton Newport Partners, in the late 60s. And for about 20 years, it achieved really impressive returns, around 20% annually on average.
Wow. Using similar quantitative ideas.
Very much so, applying probability, statistical analysis. He was also a major innovator in something called dynamic hedging.
Dynamic hedging. Okay, constantly adjusting things to manage risk. Can you give us a simple example?
Sure. Let's say Bob sells Alice a call option on Apple stock. A call gives Alice the right to buy Apple at, say, $100 in a year. If Apple's price starts shooting up towards $110, $120, that option becomes more valuable for Alice and potentially a bigger loss for Bob, the seller.
Right, Bob's on the hook.
So to hedge that risk, Bob can buy some actual Apple stock. The idea is, if the stock goes up, his potential loss on the option he sold is offset by the gain he makes on the stock he now owns.
Okay, balancing it out.
Exactly. And dynamic means he's constantly adjusting how much stock he holds based on how the stock price moves, how much time is left, and other factors. The amount of stock needed to hedge one option contract is often called the options delta.
Got it.
Thorpe and others developed sophisticated mathematical models for this dynamic hedging. He even improved on Bachelier's basic random walk by incorporating the idea of drift, the general tendency of stock prices to, on average, drift upwards over time, not just bounce randomly around the current price.
Okay, so Thorpe is building on Batchelor, applying it successfully. But it was really in 1973 that things exploded into the mainstream, right?
Absolutely. 1973 was the pivotal year. That's when Fisher Black and Myron Scholes published their seminal paper on option pricing, and Robert Merton published his own, very similar work around the same time, using slightly different, maybe more advanced mathematical techniques like stochastic calculus.
The Black-Scholes-Merton model. That's the big one.
That's the one that won the Nobel Prize later on. Even Ed Thorpe acknowledged that their model was, mathematically speaking, more rigorous and complete than what he'd developed.
And what was the core idea behind Black-Scholes-Merton? Was it similar to Thorpe's hedging?
Very much so, but perhaps framed more elegantly. Their key insight was that you could theoretically construct a perfectly hedged, risk-free portfolio by combining the option and the underlying stock in exactly the right proportions, constantly adjusting, like Thorpe's dynamic hedging.
Okay, a risk-free combination.
And if such a portfolio is truly risk-free, then in an efficient market, it must earn exactly the risk-free rate of return like what you'd get from a government bond. If it earned more, everyone would pile in, driving the return down. If it earned less, no one would hold it.
Ah. So by setting the return of this hedged portfolio equal to the risk-free rate, they could mathematically derive the only possible correct price for the option that prevents risk-free profits.
Precisely. It was a huge breakthrough. It provided a robust, widely accepted formula for pricing options based on factors like the current stock price, the strike price, time to expiration, volatility, and the risk-free interest rate.
So, wow, from a wine merchant turned physicist noticing patterns in Paris
Yeah.
to a card-counting math whiz hedging bets on Wall Street to
Oh.
this Nobel Prize-winning equation that basically underpins a multi-trillion-dollar global market. It's an incredible intellectual journey.
It truly is. It just powerfully highlights how these, seemingly abstract mathematical ideas can have unbelievably practical, far-reaching consequences, reshaping entire industries, fundamentally changing how we think about financial risk and opportunity.
Absolutely fascinating stuff. Okay, let's shift gears completely now because we also received some information focusing on a different but equally critical area, data protection.
Right. Something that, touches all of our lives now, doesn't it, in a huge way.
Definitely. In this digital world we live in, the need to keep our information secure, whether it's personal stuff or organizational data, it's just become absolute paramount. You hear about breaches all the time.
All the time. It's a constant battle.
And one company that's been really at the forefront of developing solutions in this space is Stonefly. They've pioneered a lot of technology around SAN, NAS, S3 object storage,
Right. Different types of storage networks and protocols.
as well as backup and disaster recovery, cloud integration, and even using advanced AI and security tech.
Stonefly offers a really comprehensive suite of what they call advanced data services,
Mhm.
all designed to tackle these modern data protection challenges.
Okay, like what kind of services?
Well, things like immutable snapshots, basically, creating read-only copies of your data at certain points in time.
So they can't be changed or encrypted by ransomware later.
Exactly. It gives you a clean recovery point. They also use very strong AES 256 encryption, both for data sitting on the disk, at rest, and when it's moving across the network in transit.
Okay, scrambling the data.
Right. For high availability, making sure data is always accessible, they offer synchronous and asynchronous replication, essentially, mirroring your data to other locations.
Got it. What else?
Intelligent tiering, which automatically moves data between faster, more expensive storage and slower, cheaper storage based on how often it's accessed. Smart flash caching to speed things up. And really importantly, specific features for ransomware volume protection.
Protection specifically against ransomware.
Yes. Plus, they have patented technology for immutable and air-gap repositories. That air gap is a key security feature. And they tie it all together with a unified user interface to manage everything, even across multiple sites.
Okay, that's quite a list. And they've received some significant recognition for this approach too, haven't they?
They have. Stonefly actually holds a patent specifically for their approach to immutable and air-gapped storage, backup, and disaster recovery.
A patent, okay. That highlights it's a unique technology.
It does. It underscores the innovation in how they ensure data integrity and recoverability.
You mentioned air gap there. That sounds really important, especially with ransomware being such a threat.
Mhm.
Can you explain a bit more about what that means and why it helps?
Absolutely. Think of an air-gapped backup or repository as being like a digital vault that is completely disconnected or isolated from your main computer network, physically or logically separate.
Okay, so not connected online.
Right, or connected only temporarily under strict controls. This isolation is crucial because it means even if ransomware gets into your primary systems and starts encrypting files,
Mm-hmm.
it simply cannot reach across that air gap to touch the data stored in the isolated repository. It's like having your most important backup kept in a locked safe in a completely different building that the attackers can't even find, let alone break into.
That makes perfect sense. A really critical layer of defense against those kinds of attacks.
Exactly. It ensures you have a clean, untouched copy of your data to restore from, even after a major incident.
And Stonefly's expertise has been recognized more broadly too.
Yes, underscoring their position, they received the DCIG award, which named them one of the top 5 storage companies across all 3 main categories: SAMN, NAS, and object storage.
Wow, top 5 in all 3.
Yeah, that's significant recognition. It speaks to both the breadth and the quality of their storage solutions overall.
So for listeners who might be, struggling with protecting their data, or maybe they need to expand their storage capacity to get better performance, or they're just thinking about upgrading their current setup, whether it's storage, backup, disaster recovery, even hyper-converged infrastructure.
Like VMware, Hyper-V, Proxmox environments.
Right, all those.
Yeah.
It sounds like Stonefly has a pretty wide range of solutions. And you mentioned they're competitively priced and offer good support.
That seems to be the message, yes. Affordable options backed by sales and technical support.
Could we maybe unpack a couple of those technical terms just a bit more? Like immutable snapshots and intelligent tiering.
Sure. So immutable snapshots, as we touched on, think of it like taking a photograph of your data at a specific moment. And crucially, that photo cannot be altered or deleted, not even by an administrator, until its predefined retention period expires.
So it's truly tamper-proof for that period.
Exactly. Vital for recovering from ransomware or accidental deletions, because you can go back to that clean, unchangeable state.
Okay. And intelligent tiering.
Right. So storage media comes in different speeds and costs, right? Super fast SSDs are expensive, slower hard drives or cloud storage are cheaper. Intelligent tiering is software that automatically figures out which data is being used frequently, your hot data, and keeps it on the fast, expensive tier, while automatically moving older, less frequently accessed data, your cold data, to the slower, cheaper tiers. It optimizes both performance and cost without you having to manage it manually.
Ah, clever. Best of both worlds.
Kind of, yeah. Getting the speed where you need it, saving money where you don't.
That gives a much clearer picture, thanks. And I believe Stonefly has some specific offers available right now, too.
They do. Their current promo of the month has a couple of options. One is a very affordable $10 immutable and air-gapped backup solution. Seems like a low-cost entry point.
$10, okay.
Alternatively, for maybe larger needs, they're offering a pretty substantial 70-terabyte backup and disaster recovery appliance. And this thing is expandable up to 4 petabytes, which is huge.
70 terabytes, expandable to 4 petabytes. Wow.
And this appliance includes those key features, air-gapped and immutable capabilities. It's designed to work with major backup software like Veeam, Rubrik, Commvault. It also has built-in AI features and something called object lockdown technology, specifically for ransomware protection.
Okay, a comprehensive package.
Yeah.
And the price for that?
That 70 TB appliance setup is being offered for $700.
$700, okay.
Yeah. So for anyone interested in finding out more details about either of those promotions, the contact is sales@stonefly.com. That's sales@stonefly.com.
Got it. And it also sounds like Stonefly itself is growing quite a bit as a company.
It seems so. They mentioned they're a rapidly expanding organization, and they currently have over 100 job openings.
100 openings?
Yeah.
In what kind of areas?
Various roles listed: software development engineers, technical support specialists, full-stack developers, digital media professionals, customer service reps. A pretty wide range.
Okay. So if any listeners are looking for opportunities in that tech space.
Right. They can reach out to jobs@stonefly.com. That's jobs@stonefly.com for career inquiries.
Good to know. So wrapping up the Stonefly part, it really sounds like for anyone listening who's thinking hard about strengthening their data protection or needs new storage or backup solutions, Stonefly is definitely a company worth checking out.
Seems that way.
And the place to go for more details on all their products and services is their website, stonefly.com.
Stonefly.com, correct.
And again, for specific sales questions, especially about those promos, it's sales@stonefly.com. Okay, so as we start to wrap up this deep dive, whether we were digging into the fascinating math behind trillion-dollar financial markets or exploring the really critical technologies that protect our increasingly valuable digital data, we hope you've gained some valuable insights today.
Absolutely. Our goal really was just to provide maybe a clearer lens, a way to understand these complex, but let's face it, super important areas a bit better, whether it's the elegant math trying to model market chaos, or the vital tech designed to defend our digital lives against these constantly evolving threats.
And that kind of leads us to a final thought, maybe something for you to chew on after this.
Yeah.
Thinking about that interplay in finance, the sophisticated math bumping up against unpredictable human behavior, what do you think might be the next big disruption? the next breakthrough or challenge that could really reshape how financial markets work?
That's a great question. A really interesting intersection to keep watching. And similarly, on the data protection side, given how fast cyber threats are evolving, what do you see as the biggest future hurdle? The biggest challenge in keeping our digital stuff truly secure and resilient in the years ahead? It's a landscape that just demands constant innovation, doesn't it?
It really does. Continuous vigilance, definitely food for thought there.
Mm.
And just one last time, if you are interested in looking deeper into those comprehensive data protection solutions we talked about, you can find more info at stonefly.com.
Or email sales@stonefly.com.
Right. Well, thank you for taking this deep dive with us today. We really believe that this kind of continuous learning, this exploration, is pretty essential for navigating the complexities of the world we live in.